All right, today we're going to talk about what is quite possibly the single most important and definitely the riskiest number in any commercial real estate deal. It's just an assumption, a guess about the future, really, but it can completely change the outcome of a massive investment. So, yeah, let's dive in. So, get this. In a lot of commercial real estate deals, a huge chunk, we're talking 60 to 80% of a property's projected value comes from this one single guess. Yeah, you heard that right. Most of the profit you're hoping to make, it's all tied up in an assumption about a sale that's, 5, 7, maybe even 10 years down the road. This is where the real risk is hiding. And believe me, this value is incredibly sensitive. Just look at this. Let's say you have a property bringing in $1 million a year. If you tweak your future projection by just 0.5%, just a tiny half point, you can create a nearly $2 million swing in its estimated sale price. That's it. That tiny little change can be the difference between a total home run and, well, a massive loss. Okay, so what is this powerful number? Well, we call it the terminal cap rate. And at its core, it's really just an educated guess. It's a guess about what a property's selling price is going to be at the end of your investment period. Let's break that down a bit. So to put it simply, the terminal cap rate, you'll also hear it called the exit cap rate, is basically the tool you use to turn a property's future income into an estimated future sales price. It's really all about answering that one critical question. Years from now, what is somebody else going to be willing to pay for this exact building? The funny thing is, the math itself is actually surprisingly simple. What you do is you take the property's projected income for the year after you plan to sell it, and then you just divide that by your assumed terminal cap rate. And boom, that's it. The result is your terminal value, which is just a fancy way of saying your estimated selling price. Now, to really get a handle on what this does, let's compare it to something you probably already know, the going-in cap rate. See, the going-in rate, that's based on today's numbers, what you paid for the place, what it's earning right now. It's a known quantity, it's a fact. The terminal cap rate, on the other hand, is its future twin. It's not a fact at all. It's the forecast, it's the assumption, it's that all-important guess we've been talking about. Okay, so if it's just a guess, how do the pros make sure it's a good one? Right? Well, they don't just pull a number out of thin air. They follow a really disciplined process to turn that guess into a well-reasoned, calculated assumption. The industry standard, and this is really important, is to be conservative. So first you figure out today's cap rate. Then, and listen up, this is the key part, you add a buffer, a little cushion for future risk. We're usually talking about 25 to 50 basis points, which is just jargon for 1/4 to 0.5 percentage point. Why do this? Well, it builds in that safety net, because let's be honest, the future is uncertain, and buildings, well, they don't get any younger. So what actually justifies adding that extra spread? Well, it all starts with what's going on inside the building itself. Think about it. In 10 years, that property is going to be older, the roof will be a decade closer to needing a full replacement. Your tenants, they might be nearing the end of their leases. Every single one of these things adds risk. And what does more risk mean? It means a future buyer is probably going to demand a higher cap rate, which, remember, means a lower price for the same amount of income. And it's not just about the building. Then you've got to look at everything happening outside of it. I mean, where will interest rates be in 10 years? Who knows? Will there be a ton of new, shiny buildings popping up right next door competing with you? And will investors even be as pumped about, say, office buildings or retail centers as they are today? These are these massive market-level forces that are totally out of your control, but you better believe they have a huge impact on what you can sell for. And because there are just so many moving parts, so many variables, it is incredibly easy to get this wrong. So let's talk about the most common traps, the ones that can turn what looks like a great deal on paper into a really painful reality. Okay, mistake number 1, and this is the big one, is just pure wishful thinking. It's a classic case of being way too optimistic, assuming that your exit cap rate is going to be the same, or heck, even lower than your entry rate. That is a rookie mistake. It's basically saying you think the market is going to be just as hot, your building will be just as awesome, and zero new risks will pop up over the next decade. That is a really, really dangerous bet to make. And that leads us right into the second big trap, completely ignoring market cycles. You have to remember, real estate moves in waves. It goes up, it comes down. If you buy at the very peak of the market when cap rates are squeezed super low, it is a huge risk to just assume that some other buyer, 10 years from now, is going to be cool with those same record low returns. That's something called recency bias.
It's where you think whatever just happened is going to keep happening forever. But here's the thing, markets always eventually normalize.
All right, and the third major mistake is a big one. It's failing to ask the single most important question in this whole process. What if I'm wrong? A really smart analysis isn't about just one scenario. No, it's about running a whole series of stress tests. You absolutely have to see how your returns hold up when things, inevitably, don't go exactly according to plan. And let me tell you, the impact here is huge. So look at this. In your main projection, your base case, maybe a 5.5% exit cap gets you a sweet 15% return. But what happens if the market cools off and future buyers demand a 6.5% cap rate? Well, suddenly your return could plummet to 12%. Understanding this range of what could happen is absolutely critical if you want to truly get your head around the deal's real risk profile.
Okay, so let's wrap all this up. Let's pull it all together into a simple toolkit of best practices. This is really how the smart investors manage all the risk that's baked into this, well, this billion-dollar guess.
The checklist is actually pretty straightforward. Rule number 1, always build in that conservative buffer, that 25 to 50 basis points. Next, back up your assumption. Use real sales data from similar but older properties to justify it. Write down your logic. And maybe most importantly, run that sensitivity analysis. You need to be prepared for a range of different futures, not just the one perfect scenario you're hoping for. So let's just end with this one final thought. We've seen how this single number, this one little assumption, can control up to 80% of your investment's future value. I mean, that is the very definition of a high-stakes variable. So the only question left for you is this. When it's your money on the line, how big of a safety net, how much of a cushion are you going to build into your guess?